Hello, and thank you for joining us for today's market briefing. Today we will discuss why time in the market is more impactful than timing the market. A common question many investors ask in response to market volatility is if they should hold more cash because they're worried about the potential for a significant loss. But it's getting out of the stock market during times of stress that can be more damaging to the portfolio returns in the long run. Let's begin by looking back at market volatility related to the annual returns of the S&P 500 dating back more than 50 years. As you can see, most calendar years experience a drawdown of varying magnitudes, but most years ultimately end with a positive annual return. This year, investors experienced a significant drawdown of 34% in February and March. However, the annual return thus far is 2%, with 3 months until the end of the year. Many investors may feel that there is a right and wrong time to be invested in the market given the fluctuations over time. This idea often leads investors to the concept of market timing, which means they make buy or sell decisions by attempting to predict future market price movements. Market history disputes this idea for investors looking for a long-term high growth potential, and here's why. Looking back nearly 100 years, the market faced many obstacles such as recessions, wars, and other geopolitical events. Yet, despite these headwinds, it continued to trend upward. In the past 60 years, the U.S. endured 9 recessions, amounting to 101 months of contraction. Mixed in amongst those recessions, the economy experienced 619 months of growth. Why is this important? Because market cycles and corrections are inevitable, but never permanent and often hard to predict. When the pressure to sell hits because of a market sell-off, remember that missing even just a few of the best days in the market can dramatically alter portfolio returns. The chart illustrates different outcomes for what would happen to a $10,000 investment from 1988 through the end of the first quarter of this year. The highest return is seen if you were to stay fully invested throughout the time period, turning that $10,000 into nearly $280,000. Missing only 10 of the best days within that time frame already cuts the growth potential by more than half. This means that time in the market can be much more valuable than timing the market. Despite our knee-jerk reaction of fight or flight, it is beneficial to wait out market volatility for the greatest overall return. The benefits of leaving funds fully invested even when markets become unpredictable is particularly crucial for long-term return goals. Over the next decade, some months will have better returns than others. Trying to predict which months those will be is nearly impossible. But, as we learned today, being invested during the best days outweighs the bad ones. From all of us here at RMB, thanks for tuning in. We hope you're able to join us for our next market briefing.